Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul explore the active versus passive debate. The academic research is pretty clear that US large cap active managers don't outperform their benchmarks on average. But what does that even mean? And what about Warren Buffett? And what about different asset classes and taxes? They go into index and ETF construction to help you understand where the issues may lie. In the end, even if active manager alpha is possible, it may be too impractical to identify the right manager. For instance, you won't know if you made the right call until half a lifetime later. And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hi, Aaron. How you doing?
I'm doing well today. How are you doing, Trishul?
I am also doing well. Great to be here.
Great. So today we're going to be talking about just the general idea of active versus passive. These are kind of very hot topics and keywords and buzzwords that anyone who's looked into investing in, or whether it's looking to hire an advisor or looking to invest for themselves, has obviously heard. So we want to go a quick explanation of kind of what the difference is, but have a discussion about where the risks are, why one might make sense over the other, and what the debate has looked like to help you understand it with a little more context and nuance. How does that sound, Trishul?
Yeah, great introduction, Aaron. Thanks.
My pleasure. So at a high level, anytime you've been investing in stocks for the last 100 or so years, you really just bought a stock. You called a stockbroker and you said, I want to buy Coca-Cola. So you bought that one stock. And as investment knowledge and research advanced, one of the things that started coming out was like, well, you want to be diversified. And this really meant buying lots of different stocks. So, okay, I want to buy Coca-Cola and General Electric and the local utility company. And this diversification did really help reduce some of the risk that if Coca-Cola went down or the electric company went bankrupt, you didn't lose all your money. So the first level of diversification was just buying a variety of stocks. And eventually it came out that, okay, now it makes sense to own a couple hundred different stocks. And it got to the level where it didn't make sense for an individual investor, not a professional, just buying something for themselves, couldn't really keep track of all these different companies. So investment advisors under the Investment Advisors Act of 1940 created different products, most commonly known as mutual funds, where you can hire a mutual fund manager to go out and buy the few hundred different stocks for you to have a well-diversified portfolio. And you would pay this manager usually on the scale of 1% of the investments, and they go out and do all the investment research for you. This was their day job. They would research these different companies. They'd choose which stocks to buy, which stocks to sell. And this worked really well. Just the idea that you could outsource that buying and picking and choosing and selling different stocks worked really well for many, many people. And as research got better, computers started coming into play, people started wondering, like, well, how do you tell the difference between a good manager and a bad manager? And sometimes it's just, well, a long time ago, just one would make money that would actually lose money. So that was just a bad manager. But then it's like, well, one is making more, the other is making less. And if they're using different styles, how do we compare them? And so we started introducing the idea of comparing mutual fund managers to some kind of benchmark. So instead of comparing one mutual fund manager investing in all large cap stocks in the US and another mutual fund manager investing in international stocks, because it didn't make sense to compare them to each other, we could create a benchmark to allow us to compare each manager to a benchmark. So now the manager investing in US large cap stocks would be compared to a US large cap benchmark. The most common one is the S&P 500. The Russell 1000 is also a really good US large cap benchmark. And the international manager will be compared to something like the MSCI EFI, Europe, Asia, and Far East, or there's an MSCI Emerging Markets Index, or even back in the US, there's a Russell 2000 is a small cap index. But it's just the idea that we now introduce the idea we can actually gauge how good these different managers are. The next level of research was, well, if some of them aren't consistently outperforming their index. And so before I even kind of get into the passive side of it, Trishul, what research have you seen about active managers, just mutual fund managers or professional institutional money managers comparing to benchmarks? What's your addition there?
I think there's been a good amount of research at this point that provides insight into how active managers perform against a passive strategy. So with a passive strategy, all you're saying is you want to hug that benchmark. You want to buy that benchmark. And you can now. You can buy an index fund, a mutual fund, like you just mentioned, for the S&P 500, which basically gives you a little bit of 500 different stocks. And you can get it very cheaply. And in the past, what you would likely do is pay a mutual fund manager to pick out stocks within that 500 that are meant to do better. And now we've had these two different types of models for a good amount of time, for decades, and there's a good amount of research that suggests that passive has a good amount of benefit over active. One thing I'd like to look at is this research from Vanguard, where what they basically studied is they looked at a huge universe. I think it was almost the entire universe of mutual funds. And they compared them against their different benchmarks. So they broke them down into here are all the funds that are supposed to be tracking or the S&P 500, and here are a bunch of funds that are supposed to be tracking smaller stocks, and here are a bunch of funds that's supposed to be tracking bonds. And what they did is they looked at a long-term performance of each of these different mutual funds, and they compared them to the benchmark. And here's what they noticed. So one key difference among actively managed funds versus passively managed funds is for an actively managed funds, the fees will be much higher.
Mm-hmm.
And that's because you're paying a professional or a team of professionals to figure out which stocks to pick. And that takes money. And these professionals need to be paid as well. Versus an index is just a formula. You can download that formula and trade the 500 stocks in the S&P yourself, but it can be done very cheaply with scale. But looking at the performance of these actively managed funds, what they noticed is on average, the higher their fees got, the lower their performance as compared to the benchmark.
Lower the performance after fees.
After fees.
Okay.
Yeah. And that's the return to the investor, basically. So when the fees are very low, the fees are the returns for an active manager are comparable to an index fund. But what that typically means is if the fees are so low, they're not really doing much. But as the fees grow, up to, they can grow from 50 basis points, which is 0.5% a year of the money you put in, to 100 basis points or 1% a year or 1.5% to 2%. The higher the fees, the lower the performance to the clients. Now, why does that make sense? Or why does that even happen? Well, what seems to be going on, or what could be going on, is that people are chasing returns. They initially see a fund that's doing well, and they start piling in. What does the fund do? They raise their fees. Does the fund really have an edge? Well, it seems like not, because as those fees grow, you would expect their performance to get even better. After all, why are they charging more? But in fact, over time, on average, that performance ends up getting worse. And the other thing I'd like to point out from the study that I found interesting is as the fees increase for an actively managed fund, the variability in performance increases, meaning you have, on average, people doing worse, funds doing worse as fees increase, but also the amount of under and over performance increases. And what that basically means is you have a bunch doing better, but you have a bunch doing a lot worse. On average, things are bad as fees increase. And if you think about it, what these funds with high fees are likely doing is they're taking more wilder bets, hoping to do better.
Mm.
On average, they just do worse. And then the question comes down to, okay, if mutual funds do worse as fees increase, well, why not go for funds with lower fees? If you're more likely to underperform as fees increase with an active manager, why not go for an active manager with low fees? But as I said, once you get fees that are low enough, you're just about at the return of a passively managed fund. There doesn't seem to be a big difference there.
Okay, so it sounds like when you look at actively managed mutual funds versus do you remember if it's relative to an index mutual fund that also has a fee? It's lower, but it's there, or the actual benchmark, which theoretically has no fee.
I'll have to check that, but for example, the fee on an S&P 500 product is 1/10 of 1% or 1/100th of 1% at this point. So it may not make that big of a difference either way, but I'm not sure.
Okay, so that's probably what we'll get to a little later, is just kind of actual construction of exchange traded funds and or index mutual funds. But it does sound like the academic research says that active managers, so those mutual fund managers who are charging money to make those buy and sell decisions, at the very least, after their fee, cannot consistently beat the benchmark they're being compared to.
On average.
On average. So some are, some aren't, but even among those that are, we can't necessarily figure out which ones are going to.
Yeah, that's the kicker. What a lot of people do is they look at, let's say, 100 funds, and they pick the ones that did the best over the last 10 years and say, okay, let's pick this one for the next 10 years. And it turns out that's not a great strategy. There's research to support the notion that that does not work. In fact, if you could just do that, you can basically print money, right? You could download the ones that did the best for the past 10 years every month and pick the top 10 winners out of that 100 set and do that every month going forward. That's actually a strategy employed in the not only hedge fund space, but something that's known as the fund of funds space, where you have a fund of mutual funds, right? You have managers that like to pick the best mutual funds out there, or different investment fund managers out there. And it turns out if that was easy, that people would be able to make consistent money that way, but it doesn't seem to be the case. Instead,
Okay.
you just have another layer of fees that get tacked on, which, again, higher fees tend to correlate with lower returns to the client.
Okay. So it's not necessarily that active management is bad per se. It's that it's going to charge you money and not necessarily provide value for what it's charging you. You can more or less get the same thing by going with the cheaper option.
Right. All else being equal, might as well go with the one that is cheaper.
Okay. Okay. And so I want to make sure, kind of acknowledging, sometimes the research is a little difficult, in part because exchange traded funds just haven't really been around that long. They haven't been around as long as the indexes that they're being compared to. So a lot of the really good research is comparing it to that I've seen is comparing the mutual fund manager after their fees to a benchmark without fees. And it's important to kind of add that part in, just conceptually. It's going, like, I agree, it's going to be extremely cheap and probably negligible, but when you're looking to invest in the S&P 500, you can't actually invest in that index. You have to choose a mutual fund or exchange traded fund that replicates the S&P 500. They just buy all the same 500 stocks that are in the S&P 500, and you get a fractional percentage of that. So for all intents and purposes, you are choosing that benchmark, but there are slight construction differences. And because there's no person that's making those buy and sell decisions, it's entirely algorithmic. They just have to set it up, and then there's no active buy and sell decisions. It's just kind of custodial work of handling money coming in, money going out. They're able to get much, much cheaper. Like you said, mutual funds are probably on the scale of 1%, whereas index mutual funds and or exchange traded funds or ETFs probably on the scale of 0.1% to 0.2%. Some are as high as, say, 0.35 if they're getting into different asset classes. Others are as low as 0.01%, so 1 basis point. Like I said, a 1/100th of a percent. And by keeping these fees really low, they're able to outperform a decent number of the active mutual fund strategies. Does that kind of sound like a good summary?
That does, yeah. One thing I would highlight is we just threw out a lot of fees here and percentages. So I think it's worth noting what these numbers really mean in terms of their impact. Because, when somebody hears 1%, they think, that's a small number. I have a million, I have $1,000 and 1% of that's nothing. It's 1%, right? What's a big deal? The market moves up and down 1% a day.
Yeah, $10 on 1,000.
Yeah, who cares? But if you track 1% a year over an investment lifetime, you're actually talking about some big bucks. So I think that's something to keep in mind. Like, for example, when we're looking at these types of actively managed funds, one thing that I like to think about is, okay, what is the impact of a passively managed fund with, an average fee of something that's a lot smaller compared to a passively managed fund where the average fee is, something like, call it 80 bips or something. So I actually, ran a few numbers sometime in the past on that type of scenario. And I just tried to see, okay, what is the difference over an investment lifetime? And the difference that I found was actually a lot larger than I expected. So what I compared is two instruments, one that charges 8 basis points a year, like what you said might be comparable to a passively managed fund, and something that charges 67 basis points a year. That happens to be an average for these types of actively managed funds. And I looked at the difference over 45 years, and the amount of impact something like that has is over that period, you end up giving up over a third of your upside in fees.
So you have 2/3 of what you would have had if you by giving up that 59 basis points per year. So
Right.
Instead of having $1 million, you have $670,000.
Exactly. And guess where that $330,000 went?
And so that's just the difference in fees.
Yeah. So
Okay.
it's a notion that if you pay more fees, you'll have less money to invest, right, on your end, and your money will grow more slowly as well. There's this compounding effect that people may not realize.
Okay.
So these differences can be important to understand.
Okay. So we have an idea of the scale and context, why these fees matter. If we can't necessarily get better performance from an active manager and we get the same even just get the same performance or slightly better performance after fees, then that difference in fees enough can be on a scale of hundreds of thousands of dollars over a lifetime.
Right.
So, what would you say to the success of someone like Warren Buffett?
Well, there's a few things to keep in mind. Even with active managers over a rolling 10-year period, somebody has to do better. Just that's how probability works. If you have a bunch of people playing the markets, somebody is going to outperform over a 10-year period. And to a lesser extent, there will be people or fund managers that outperform over a 20-year period and 30-year period and so on. And maybe there'll be 10 people who will outperform over their lifetime. Now, if you think you're going to be one of them in terms of the average person, I think you need to understand what odds you're up against. Think about it this way. Let's say we're playing a coin flip game. What are the chances of me guessing heads or me guessing the right flip heads after one flip? 50-50.
Yeah.
Okay, how about I do it twice? Well, 25%. Okay, after 3 years, I'm flipping one coin a year, 1/8, and so on. So after 30, 40 years, what are the chances of consistently doing better? It's quite small.
Okay.
But there has to be somebody who is able to do it.
So,
Now
you're describing the Wyatt Earp effect that's come out
right.
in statistics. The when you have two gunslingers in a battle, and you have enough of these people, eventually someone has to have gone through 5 successive gunfights without dying. And it may not be that he's slightly better if they're all comparable skill, but you just start off with, in this case, 2 to the 5th, 64 gunslingers, and through a tournament model, eventually one of those 64 has emerged as the best gunslinger, even if it was just 50-50.
Right. And this is something you may have heard. There actually statistically should be more Warren Buffetts. So it seems like we're kind of shooting ourselves in the foot in terms of how many we should have if people just randomly tried to be Buffett.
Okay, so I understand what you're saying in terms of statistics, and I do have a math background, and I like being able to explain the Wyatt Earp effect in more depth later on, or if someone else asks. But I bring up Warren Buffett specifically because I do think there are some managers who have shown a skill to do better. And Warren Buffett specifically addresses kind of one of the things that you mentioned earlier of, I think he made good decisions early on. He tends to be a little more on the passive long-term buy and hold strategy. So he's not placing too many trades. But as he got bigger, he changed some of his investment strategies and took advantage of the fact that he was bigger. He started making investments in individual companies that were only available to him at his scale, that weren't available to regular individual investors. And going through 2008, 2009, I believe he was making large preferred loans to, I think it's either John Hancock or Johnson & Johnson, where he was getting a 9% loan on one of these companies. And that's the kind of thing that he did as he got bigger, was that he didn't try to bring the strategy that worked at the beginning and then assume that would continue to work down the road, which unfortunately is what most active managers do. That they kind of try to apply the thing that worked when they're small to have it work when they get big. And so I do think Warren Buffett has done a better job, and I actually do think he is a good active investor, but it's in part because he can adjust and take advantage of his scale where everyone else can't.
I do agree with that. I'm a Warren Buffett fan. I probably quote him enough on this podcast, but I would say a few things related to his performance. One, I think I mentioned this paper before where if you look back, there was research done on the performance of mutual funds 10, 20 years ago versus the near history 5 to 10 years ago. And it turned out that in this paper, they tried to determine were there actually active managers out there that were skillful beyond what would be predicted by luck alone versus what might be just predicted by luck. And what the paper found is if you look back closer to the 90s, there were skillful managers beyond what luck would predict. There were mutual funds that were doing better beyond what luck would say you might expect, meaning out of 100 managers, 10 have to do good, right? But
Mhm.
if you have 20 that do good, well, geez, you must have people who are skillful, or it's more
Okay.
likely that you have people who are skillful. So that they had 20, for example. I'm making up numbers, but
Yeah.
so they had 20 in the 90s, but in the closer to the last decade, you had close to zero beyond luck. So
Mm.
I think what I'd say is it may have been easier in the past to be skillful, and that may have contributed to part of Warren Buffett's returns. And even so, let's say he is still skillful today. I think he's in a big minority. I don't think there's a lot of managers out there, and I think it's going to get even harder. The other thing I'd say about the strategies that Buffett puts forward with his investments are, you're right, they tend to be larger. He tends to have the ability to have access to ideas that probably nobody else on the planet has access
Hmm.
to besides large governments. And also, he does a very good job of handling the tax situation when it comes to his investments. Because I think a large amount of performing well is understanding the impact of taxes. And that's
Mm.
something we should definitely talk about. But his notion with buy and hold is sensible because if you hold and never sell, you never have to pay taxes.
Okay.
And if you're always selling and trading and buying this new thing and that new thing, you're constantly paying taxes. And it turns out that can make a huge difference that compounds over time. And the way that he set up his company is he absorbs other companies to make the money flow through his enterprise very tax efficient.
Yeah. I completely agree with that. That the taxes are another big factor. And I have seen some active managers focus on the taxes well enough that they just specifically design tax managed strategies, and they can do better than passive strategies on a after tax basis, but their investment returns, whether gross or net, may not be distinguishable. Where you can tell they're specifically making their investments with tax focus in mind, but they're not necessarily trying to add investment alpha through picking good companies. They're just trying to be more cognizant of the tax ramifications. Whereas passive strategies, while there's very little turnover, so there's very little buying and selling, they do still have some kind of dividend yield. If you just invest in the SP 500, you're going to get 1.5%, 2% per year in dividends. And so you will have to pay taxes on that. So there are ways to do better on an after tax basis, but not necessarily on a gross return basis.
Right. I agree with that.
And so the reason I bring up again bring up Warren Buffett is I do think that management skill exists, and it sounds like in terms of your timing, that's possible in especially in the U.S. and especially for large companies that just communication technology and the internet have made it possibly if at the very least impractical, if not impossible, to show off that skill when investing in U.S. large cap companies. There's too much information going too fast that no one person can outperform the market.
Yeah, I think the enhancements like technology and automation and artificial intelligence and machine learning and all of that has made things a lot more challenging. For example, before maybe what somebody used to do is if they're following IBM, they might keep track of the earnings that come out for IBM, and then if the earnings are good, they might place a trade. If they're not in line with what people expect, they might sell or and so on. But here's what happens now. The second that earnings hits the news, a computer has already read that article, figured out exactly what trade to place, and place the trade before that email will load on your system.
Yeah, yeah.
So you're up against a pretty steep hill. Any news article that comes out on IBM is going to be digested by a computer and a trade will be made if it's relevant. So being able to be on top of what's going on at that fast of a pace in such a competitive environment, I think is going to be increasingly challenging.
Okay, so Warren, so maybe Warren Buffett's success came before computers were as prevalent, and his adjustment to other kind of buy and hold or access to investments that we don't have access to as computers did become relevant might be why Warren Buffett might be able to be successful as an active manager, but the situation is not replicable.
I think it'd be a small minority that can pull it off, I'd say, and trying to find that needle and be sure that you found it, and then be concerned that after the fact you won't even know that you didn't find it until it's too late. I think it's tough. It's a real tough game.
I think that's a great point, is that even if you had the perfect strategy, you won't know if you had the perfect strategy until halfway through your lifetime. And if you didn't have the perfect strategy halfway through your lifetime, you can't go back and then go back to a better strategy.
Right. You only get one shot. And, let's say we mentioned this before. If you fall behind by 2% over or 20% because you miss out on a good year, you'll never catch up, or it'll be very hard to catch up.
Okay. So when it does come to this idea of active management, I do think the skill exists. It might be hard to find, it might be hard to replicate, but I think that skill exists. What I start to look at is other asset classes, whether it's outside the US, whether it's on the bond side. I think that there is opportunity for active management to do better than an ETF. An actively managed mutual fund to do better than an ETF in asset classes outside US large cap. And I do think that there's a little bit of a spectrum here. So international developed companies probably have a lot of the same information as US large cap, so probably not much to gain. Small cap, also similar, but you just have slightly less you have more companies and a little less information. So maybe a small ability to display that manager skill, but still probably less likely. One of the things I start to look at is on the bond side. And here it's important we need to get kind of into index construction a little bit, but at least understanding where the risks are. So with the S&P 500, the way it chooses these companies is the 500 largest companies by market capitalization, basically just size of the company. It's kind of outstanding shares times share price is the size of the company. And they weight the S&P 500 by this market cap. So the biggest companies are represented more in the S&P 500 than the smaller large cap companies. It works similar with bond indexes, where now it's not market cap by size of the company, it's market cap by size of the borrowing. And so the US government's actually the biggest borrower. So any kind of bond index is going to have a lot of treasuries, Fannie Mae, Ginnie Mae, and other US government-backed bonds. But when they start to go into corporate, or if it's an ETF that's focused only on corporate bonds, it's going to be, the index itself is weighted by the borrowing. So the company borrowing the most is the greatest representation in the index. And there is a little risk here. I don't think that it needs to be a big concern. Just still, a bond ETF is going to be more conservative than a stock ETF. But it is one of those things to keep in mind that the company borrowing the most is not necessarily the healthiest company. They are using that borrowing and using those bonds as leverage to try and generate better returns on their equity. But that, again, like we've talked about in the past, that doesn't necessarily make it bad or good, but that is a little higher risk. And so with a bond ETF, if you look into the construction, you might either get more US Treasuries, which are really conservative, really low yielding, or kind of more companies that are borrowing a lot. And understanding kind of how the index is constructed is important part of bonds. And I do think that there is some opportunity for a good actively managed bond manager to choose bonds that are different than the index and find a better sweet spot on that risk return spectrum. So I think bonds can be one area that an active manager can outperform a passive strategy. Now, bond returns are pretty low in general right now, and actually have been for on the scale of a decade. So right now, especially over the last 10 years, it's also not necessarily realistic to expect a bond manager to outperform a bond ETF after fees. But if the kind of theories of how the ETFs are constructed, and if interest rates ever look like what they did prior to 2010, where you get some kind of these fluctuations between 1 and 7%, then it might be possible for bond managers to display skill. If we stay at a 1 to 2% Fed funds rate for the next decade, probably not. But if there is some variation over time in interest rates, then there may be opportunity for active managed bond managers to show some skill. So I'm curious, Trishul, have you seen any research or through your own observations of bond ETFs compared to active managed bond strategies?
Well, I understand what you're saying. Basically, there may be pockets within the investment universe where there's areas where it might still be possible to provide value through an actively managed routine, or it's more likely to provide value. As I mentioned, on the equity side, when you're looking at companies that try to, or mutual funds that try to do better than the S&P 500, I think from that perspective, where there's been a lot of research and that those markets are very mature, I think it's difficult. But I can see what you're saying, that in markets like bonds, or even, as you mentioned, the overseas markets, there may be pockets of areas that there are still more opportunity for skill to come into play. That makes sense to me.
I do want to warn, I'm not saying that go find a good China emerging markets manager because that China emerging markets active manager is going to outperform the China emerging markets index. And if you look at iShares, just has hundreds of different ETFs at this point for any individual country or market that you want to find. The overall asset allocation, still the majority of most clients' portfolios should still be in US large cap stocks, developed countries large cap stocks, and some conservative bonds. It's the majority of most clients' portfolios is going to be in those things that it's okay to use ETFs, and looking for those outperformance may not be worth it. but it helps inform the discussion of active versus passive. It's not, again, it's not active is bad or wrong. It's once an asset class kind of has enough information going so fast, the likelihood that an individual person can outperform a benchmark goes down dramatically.
Right. I think that ties into the notion of markets gravitate towards efficiency, but not every market is as efficient as every other market.
I agree with that. Yes. And one thing I do point out to some of my clients, is mostly because I'm in California, is that using California muni bonds can make a lot of sense. So muni bonds are municipal bonds, and if you they are already federally tax-free, but if you buy state-specific municipal bonds for the state that you live in, they can also be state income tax-free. So a California muni bond would be very preferential for California residents who have very high state income tax rates. And for California muni bonds, the ETF available for California muni bonds actually has kind of construction issues where the ETF itself is not large enough and the liquidity isn't great enough to really work in a model portfolio for ETF strategies. It doesn't work with automatic rebalancing very well. It doesn't track kind of prices of California bonds as effectively. And so that is still one area that I specifically make sure to recommend to clients, is that for California muni bonds, a mutual fund or an active strategy still makes more sense. And that might be an example of what you're talking about. It's like just that particular market does not support the pure passive strategy.
Right. That's a great example, Aaron.
I was wondering, have you seen anything else like that where your strategies, and it might be getting a little esoteric, maybe like a risk parity strategy or on commodities or other alternatives, anything like that, where uh, the information just isn't quite there and an active strategy probably still makes sense over a passive strategy?
Well, I come from the institutional investing side, and in that space, it's all about finding these types of strategies where generally an institution has, call it 100 million, a billion, $10 billion, and they need to put it to work according to a mandate. And part of their mandate is to put some subset of that money into a strategy that's non-traditional. They call them alternative strategies. And the notion behind alternatives, it's a secret word for hedge fund, is that these are strategies that are designed to look into markets that are very niche, that are very esoteric, that are designed to be invested in by professionals who devote their lives to understanding this very tiny area in order to scope out performance or returns. So I've seen that. I used to manage one myself in a former life as a hedge fund manager. And yeah, it's certainly possible. It's one of those things where markets will be born and new markets will come alive and markets will disappear, but there might be a window where there is an opportunity out there. And that's why this industry exists. It certainly has been a fun game on the institutional side, but I think what I've kind of learned over the years is that on the institutional side, they are trying to come up with this edge beyond what somebody can do on a passively managed retail portfolio. But in all honesty, the funds or the institutions I've seen, again, as small as a few hundred million to as large as tens of billions, I don't know if they found a secret that will persist, that will allow them to continually beat the market by finding these esoteric strategies. I think that's TBD. And even though they may exist for some time, I think on the whole, having this as a investment idea that's sensible for institutions, I kind of question that, to be honest.
Okay, so trying to summarize kind of how this discussion impacts advice to clients and kind of why many advisors end up providing similar advice, especially among RIAs who have a fiduciary obligation. There seems to be a pretty overwhelming lean towards passive. It's not necessarily saying that active management is bad. It's more understanding that while active management outperformance is possible, finding it is very difficult, if not impractical. It's possible that it has to be too esoteric and might involve risks that don't make sense for individual clients. You don't know if you made the right call until half a lifetime later when you can't go back. So instead of risking your life savings on something that may or may not work, just go with the thing that's most likely to get good enough for the lifestyle that you want. And it does sound like passive strategies fit that for most individual investors. This is going to do the best for you because those fees will be down, and we're definitely not going to underperform the benchmark. We're definitely not going to miss out on some big opportunity cost. It's a little more dependable in that regard, that you're going to get market returns, and that's all you need for the lifestyle that you want.
Great summary, Aaron. I like it.
So I'm a little curious. I want to ask you to go a little deeper. You used to work for a hedge fund. You have done these strategies, and you still recommend passive to clients. I feel like there's a kind of a dichotomy there, a little oxymoronic of the hedge fund guy is saying go passive.
Well, I've seen the ins and outs of that industry, and I see what everybody's trying to do and chase. And I feel like a lot of effort for the opportunity to do better, but not necessarily the results. I remember looking at one institution's overall performance, and I just ran some numbers, and I came back. I didn't present this to them, but what I noticed is if they had just invested in the 60-40 bond portfolio, they would have done far better than I think probably the $1 billion they spent on fees to other managers.
So even among the pensions that are investing the billions of dollars, they're making the same mistakes that every individual investor is making.
I personally think so. Part of it comes down to if all the other big institutions are doing it, you don't want to be the one that says, I'm spending 20 cents on index fund from Vanguard, and I'm the one who doesn't have a whole team looking after all of this money. It's an institution for a reason because it's institutionalized. The notion that this is the procedure you follow, this is what everybody's done. This is a generic portfolio where you have 20 stocks, 20 bonds, 20 international, 20 real estate, 20 commodities, and so on. And you find the best managers to fill up the buckets. That's just how they operate. And they have a mandate written in 1,000 pages of body of contractual work that they have to follow in order to live up to be a fiduciary when you're running an institution fund. So I understand why they do what they do. I just kind of question whether all that effort is worth it.
Mm-hmm. So I think I hope this has been helpful and insightful, that active versus passive is not good versus evil, or vice versa. It's just kind of what's makes the most sense for most people, kind of thing. And I think that that's part of the reason why this debate continues to last, and why passive just hasn't completely dominated future investing strategies. I do. There's a argument I've heard that you do need some active management to kind of keep the market efficient. That when the earnings call comes out, you still need some people placing those trades right away to make it efficient. But I think you only need on the scale of 5 to 10% of the market to keep it that way. You just need 5% of investors competing against each other, and the rest of the 95% of the population can benefit.
Yeah, we can leave that to the robots.
Yes, that's the future of humanity, is that we're no longer investing for ourselves. We're just benefiting from their labor.
Seems like it. That's going to come with a host of other problems, but maybe that's for another day.
Okay. So do you have any other kind of final thoughts on active versus passive, on implementation, what you do for yourself versus what you recommend to clients, or even do you find that your personal investments are in line with your clients' investments, but your profession was different in the past?
I kind of see that. Like, for example, I believe that when I was running a strategy, did find an idea that worked and was sensible. I'm not sure it's an idea that'll last forever, just because I think markets do gravitate towards efficiency. But for that pocket of time, and maybe still, I think it's a notion that makes sense. But that doesn't mean it makes sense for consumers and for clients or even myself. So,
Okay.
from my perspective, I'm largely passive. I mentioned in one of our earlier conversations, I keep around a few stocks as a lesson to not trade. I think Berkshire is one of them, but the lesson I learned was the other stocks weren't as good. On the whole, I'm pretty much passive in my portfolio, and that's what I recommend to my clients. As you mentioned, there may be small opportunities here and there along the spectrum to make a more tactical decision for clients, and I certainly understand why that may make sense. But the bulk of that distribution, I think, is passive in terms of what I would recommend.
Okay. Okay. I I feel like I devote more energy explaining the active versus passive debate. So the conversation we've had today, I've had with clients many times, than I do actually analyzing active versus passive investments in a client's 401k. I think that tends to be my take. I tend to be more agnostic. Like, just the allocation of stocks to bonds is so much more important. I'm almost indifferent if you use the emerging markets active manager versus emerging markets ETF or index option in your 401k, just as long as you have some emerging markets, and it's going to be on the scale of 5 to 10%. So I will spend more time and energy focusing on the asset allocation for each individual client, especially in a 401k that the taxes don't matter, and just whatever option they have available to you. And a lot of times I will just whatever is the lowest fee option. But if they have only actively managed funds available to them, I don't think it's that big of a deal. I'm not concerned about at all that the taxes matter more, the asset allocation matters more, and the actual construction of that asset allocation is just farther down on the priority list. If I have clients who come to me with ETFs and they want to stick with ETFs, I have no problem with that. If I have clients who come to me with and they want to choose active managers, I don't think that they're risking their retirement by using active. It's, in general, I find that it's not worth the time and energy to have that discussion as much and do that kind of research than the actual benefit from passive. And I think that's another reason why most advisors lean towards passive, that they don't want to have to go out and compare different large cap mutual funds, because it requires a lot of time and energy to do that, and there may not be any benefit. So if we just pick the passive one, we're going to do well enough, and I can focus my time on helping you with taxes and lifestyle and spending and savings and the other things that actually do make a difference in your life.
I think a lot of what you say makes sense. This was certainly a great conversation.
Well, thank you very much, Trishul. I look forward to our next conversation.
Great. Well, thank you, Aaron. And thanks everybody for listening. I appreciate you tuning in today. And if you like what you hear, let us know. Okay. Thanks, everybody.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.